Over the last couple of months, a few clients have expressed concern over their allocation to private credit based on some rather alarming media headlines. That's the subject of this video: private credit, how the media manufactured a crisis. I want to dive right in and address some of these headlines. Just a few days ago, on February 19th, the Wall Street Journal's headline blared, "Private credit warning signs flash after Blue Owl unloads $1.4 billion in assets." And just a few weeks before, CNBC's headline read, "Wall Street braced for a private credit meltdown." These are pretty scary headlines, and if true, one should probably run for the hills and get out of private credit. But on a closer look, and I never thought I would say this, it's fake news. Seriously, it is utter and complete rubbish. You know, the media does a pretty darn good job of instilling fear and panic. Now, some of our older clients might recall a movie called Citizen Kane. In case you're not familiar with it, the movie is from the 1940s and is considered a classic. It is based on the real life of newspaper tycoon William Randolph Hearst. There's a scene in the movie where the newspaper mogul tells his reporter, "You provide the prose poems, I'll provide the war."
Yes, dear Wheeler, you provide the prose poems, I'll provide the war.
This is known as yellow journalism. It is a style of reporting that prioritizes sensationalism over facts to grab attention and sell more papers or clicks. In the movie, Kane deliberately sensationalized news and manufactured outrage to sell papers and build his empire. The tension between responsible journalism and ratings-driven sensationalism has never gone away. You've heard of similar quotes like this: "If it bleeds, it leads." Or, "Never let the facts get in the way of a good story." There are so many of them, they are almost laughable until you see that someone is getting hurt. A quote attributed to Thomas Jefferson is, "The man who reads nothing at all is better educated than the man who reads nothing but newspapers." Malcolm X put it even more directly: "The media is the most powerful entity on earth. They have the power to make the innocent guilty and the guilty innocent." And for any of you old rock fans from the 1960s and 70s, a quote attributed to Jim Morrison from the rock band The Doors is, "Whoever controls the media controls the mind." All right, with that preamble out of the way, let's now talk about private credit and some of the recent headlines. This video is broken down into 5 parts. First, I want to define what private credit is. 2, then I want to address another sensationalized headline that Jamie Dimon, the head of the world's largest bank, recently said about private credit. Third, I want to debunk the most recent headline regarding Blue Owl's private credit fund. Then I want to talk a little about the banking industry and its relationship with private credit. And lastly, what I believe will be of greatest interest, I want to talk about the role private markets, both private equity and private debt, play in our economy today. Most of you have investments in these asset classes, and they play an important role in your asset allocation. So please stay tuned to the very end. All right, so let's start off with a brief explanation of what private credit is. Private credit is exactly what it sounds like: credit that is private. Instead of borrowing through a bank or issuing bonds that trade publicly on the market, a company borrows directly from a private fund. No intermediary, no public market pricing, a direct loan between lender and borrower. To understand why this exists, think about what the alternatives look like. A bank loan gets packaged up and sold. The company often has no idea who actually holds their debt 6 months later. Public bonds require disclosures, ratings, roadshows, and the scrutiny of public markets. For many companies, neither option is appealing. They want a lending partner who knows their business, structures a loan around their specific needs, and stays in the relationship. That's what private credit provides, and the typical borrower isn't a struggling company scraping for financing. It's an established, privately owned business, often backed by a private equity firm that is invested in and owns the company, with real revenues, real assets, and real cash flow, such as a regional manufacturer, a healthcare services provider, a software business generating steady recurring revenue. The loans themselves are predominantly senior secured, which is the most protected position in the capital structure. If a borrower runs into trouble, the senior secured lender gets paid first, before anyone else, and they have a legal claim on specific collateral backing the loan. equipment, inventory, accounts receivable, real property. This isn't speculative lending, it's collateralized lending to operating businesses. For investors, the trade-off is straightforward. You give up the ability to sell your position on any given Tuesday. In exchange, you earn a meaningfully higher return than publicly traded alternatives, historically 9 to 10% annually versus 4 to 5% on investment-grade bonds. Think of that extra yield as your reward for being patient. You're giving up easy access to your money, and the market pays you well for doing so. The private credit market has grown to over $2 trillion globally, projected to reach $4 trillion by 2030. That growth isn't the result of financial engineering or exotic risk-taking. It reflects a structural shift in how companies prefer to finance themselves and how a growing number of investors prefer to deploy capital, quietly, directly, and with real collateral backing every loan. All right, now with that definition out of the way, let's address a nice juicy headline that the media picked up on that emanated from Jamie Dimon, the CEO of JP Morgan, one of the most powerful bankers in the world, whereby he warned about cockroaches in private credit as recently as last October. Here's what he actually said. My antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this. Wow, the media just loved that statement. Sounds ominous, but let's look at what he was actually referring to. Two companies had gone bankrupt, an auto parts supplier called First Brands and a subprime auto lender called Tricolor. Both cases involved alleged fraud. First Brands was accused of using the same invoices multiple times to borrow from multiple lenders simultaneously without disclosing it. Tricolor was making car loans to borrowers without credit scores or even driver's licenses, then packaging those loans and sending them to investors who apparently never looked under the hood. Now here's where it gets really interesting. Cliffwater, one of the most respected independent research firms in the private credit space, published a report on November 7th, 2025, titled No Cockroaches in Private Debt. Their conclusion? These weren't private credit failures at all. First Brands was a bank loan deal where, in Cliffwater's words, the bankers appeared to be more interested in deal fees than due diligence. And Tricolor? That was a bank-led subprime auto loan deal that created large losses, and here's the irony, for JP Morgan itself, along with other banks. So the CEO of one of the banks that lost money on a bank-led loan gone wrong was warning the world about cockroaches in private credit. Cliffwater put it plainly. Casting fear about private debt has been a hobby for bank executives, the business press, and a few policymakers for several years now. None of these concerns have materialized. And Blue Owl's CEO, Mark Lipschultz, didn't hold back, speaking publicly the very next day. He quipped, I guess he's saying there might be a lot more cockroaches at JP Morgan. He went further, calling the whole episode an odd kind of fear-mongering, and argued that if anything, investors should be moving away from bank loans and into private credit, which he described as incredibly healthy. All right, so that brings us back to where we started. That Wall Street Journal headline from just a few days ago. Private credit warning signs flash after Blue Owl unloads $1.4 billion in assets. Interestingly, it's the same Blue Owl whose CEO had publicly called out Jamie Dimon just a few months earlier. And as Cliffwater put it, casting fear upon private debt has been a hobby for bank executives and the business press and a few policymakers for years now. So what actually happened? Blue Owl had a fund that was always designed to have a finite life, meaning from day one, the plan was to eventually wind it down, sell the assets, and return money to investors. That's not a crisis. That's the fund doing exactly what it said it would do. Blue Owl ended up selling over $500 million worth of loans from the fund. And here's the part the Wall Street Journal didn't put in the headline. The assets sold at essentially full value. And the buyers, major pension funds and institutional investors who, according to reports, wanted to purchase significantly more than what was available. For context, since its March 2017 inception, the fund's underlying loan portfolio had returned an annualized 9.11% through September 30, 2025, nearly identical to the relevant index at 9.19%. This wasn't a troubled fund dumping assets. It was a well-performing fund executing its plan. Think about that for a moment. If private credit were in trouble, pension funds wouldn't be lining up asking to buy more. This is actually a pattern you see time and again in financial markets. Retail investors read the headline and panic and sell, while the largest and most sophisticated investors in the world see an opportunity and move toward it. The pension funds managing the retirement savings of teachers, firefighters, and government workers were the buyers here. That tells you everything you need to know. Meanwhile, Blue Owl had already launched a successor fund with $20 billion in new commitments. That's not a company in distress. That's a company executing its business plan and immediately raising more capital because investors want in. Do you remember the line I gave you earlier from Citizen Kane? The one I referenced about the media? You provide the prose poems, I'll provide the war. And by the way, Prosperity Advisors has no clients invested in any Blue Owl private credit fund. All right, let's move on. Let's go on to part 4 here, the history of private credit and its relationship to the banking industry. And I want to start with another famous line, this one from the classic 1976 film, All the President's Men, the movie about the Watergate scandal that brought down President Nixon. A secret informant advises the investigative reporters with just 3 words: follow the money. I think those 3 words are worth keeping in mind as we talk about why banks have been so vocal in their warnings about private credit. Because here's the thing. Banks didn't just lose a little business to private credit. They lost an enormous, highly profitable lending market. When you understand the scale of that loss, it's at least worth asking whether the warnings coming from bank executives are purely about concern for investors or whether something else might be at play. Here's something that doesn't get talked about enough. One of the reasons private credit has grown so dramatically is that banks have actively retreated from this type of lending, and it wasn't by accident. After the 2008 financial crisis, regulators imposed significantly higher capital requirements on banks through legislation like Dodd-Frank and international banking standards known as Basel III, named after Basel, Switzerland, where global banking regulators meet to set the rules. In plain English, banks were required to hold more capital in reserve against risky loans. Middle market lending, loans to privately owned companies without public credit ratings, became expensive for banks to keep on their books. So they stopped doing as much of it. The irony is that this created an enormous opportunity. Thousands of solid, well-run private businesses still needed financing. Private equity firms, the professional investment groups that own and operate many of these companies, still needed debt to fund acquisitions. The demand didn't go away. The banks just left the table. And into that vacuum stepped private credit funds, which had no such regulatory constraints and were willing to be the long-term lending partner that banks could no longer be. This is actually one of the structural reasons private credit tends to have better underwriting than traditional bank loans. As Cliffwater Research points out, banks originate loans and then immediately sell them off to other investors, collecting their fees up front, but passing the risk of default onto someone else. When you don't hold the loan, you have less incentive to scrutinize the borrower. Private credit funds, by contrast, hold the loans they make until maturity. Their own capital is on the line. That alignment of interests makes a real difference in the quality of underwriting and ultimately in the safety of the investment. So when you hear that private credit has grown from virtually nothing in 2008 to over $2 trillion today, understand what that actually means. It isn't a bubble. It's banks handing off a market they no longer truly could serve, and a new class of lenders stepping in to do it better. Now, I want to talk about what I feel is the most exciting part of this video from an asset allocation perspective. A brief dive into the role private equity and private debt have in your portfolio. Think about how large the private market actually is and how dramatically it has shifted over the last 3 decades. Let's take a look at the following charts and data provided by Apollo Global Management's chief economist, Torsten Slok, one of the most widely followed economists on Wall Street. Starting with the United States, of all US companies generating more than $100 million in annual revenue, 81% are privately held, only 19% are public. But this isn't just an American story. In Europe, 96% of companies of the same size are private. In Asia, 87%. This is a global structural reality, not a local anomaly. The vast majority of the world's significant businesses, the ones with real revenues, real employees, and real assets, never show up in your stock portfolio. And here's something that might surprise you. While the private universe is growing, the public stock market is actually shrinking. The number of publicly listed companies in the United States has fallen by nearly 1/2 since its peak of over 8,000 in 1996 down to around 4,300 today. And it's not just that fewer companies are going public. Companies that are already public are actively deciding to delist and go private. The number of public companies being taken private has risen steadily from just a handful in 2008 to over 40 deals annually in recent years. And here's something that tells you everything you need to know about where the smart money is going. This chart shows the number of billion-dollar-plus transactions. The blue bars represent companies raising capital privately. The green bars are IPOs, meaning companies choosing to go public and raise capital through a public stock offering. The trend is striking. The blue bars keep climbing year after year. The private market isn't just growing, it is increasingly dominating where the largest transactions in the economy are happening. The largest, most dynamic companies in the economy are increasingly choosing to stay private and raise capital away from public markets. They are voting with their feet, and when they do, they need private credit and private equity to finance their growth. That is precisely why this market has grown so rapidly. And then there are the unicorns. Private companies valued at over $1 billion. In 2016, there were 114 of them in the United States. By 2025, that number had grown to 857, nearly 8 times as many in less than a decade. These are not struggling startups. These are substantial, fast-growing businesses that have made a deliberate choice to stay out of public markets, and they need capital to keep growing. So when you put it all together, thousands of large private companies, a shrinking public market, a rising tide of companies going private, and nearly 900 unicorns, the demand for private credit isn't a fad or a bubble. It is the inevitable consequence of where the economy has moved. The private market is where the action is, and private credit is how it gets financed. This is precisely why we have private equity and private credit in your portfolios. These aren't exotic or speculative investments. They are a direct reflection of where the real economy actually lives. As we wrap up, it is important to recognize that private credit and private equity are not single uniform investments. There are hundreds of managers and strategies in the space, each with its own structure, fees, risk profile, underwriting standards, and performance history. Some focus on highly conservative senior secured lending. Others take on more leverage or pursue more aggressive growth in search of higher returns. Part of our job is to live in that complexity on your behalf, to sift through managers, evaluate their track records, stress test their assumptions, and perform ongoing due diligence so you do not have to. While no investment is risk-free and past performance never guarantees future results, the private funds we have selected for your portfolio represent, in our judgment, some of the strongest, most disciplined managers in the industry, selected to fit thoughtfully within your overall financial plan. Now, lastly, a word about risk, because it would be irresponsible not to mention it. Investing always involves risk. Whether it's the stock market, the bond market, crypto, commodities, or real estate, there is no free lunch. Private markets are no different. The risks are real, and it's important to understand them. But so are the benefits: higher potential returns, lower correlation to public markets, and the extra yield we discussed earlier that rewards your patience. The key is that private market investing is designed for the long term. If you have the patience and the time horizon, the evidence strongly suggests it rewards you for it. And that is exactly the framework within which we have structured your portfolio.